This is a Highmount Research Market Insights video for May 11th, 2023. Good afternoon, everybody. Willie Delwich here. Glad you have tuned in. Glad you are listening. Spring is in the air in Milwaukee. It's warm outside. The sun's out. The plants are in the ground. It's a great time to be in the garden. It's not such a great time to be in the market. It's a messy, range-bound environment that we've been in for a while. We're going to get into that as we go into this week's Insights video. We'll start though with the news of the week. I think that's probably inflation. Break that down and then work through some of the evidence and finish up with a look at where we see the market right now. So inflation, CPI data came out earlier this week. Headlines heralded as a great advance, a great improvement, evidence that the Fed could pause, perhaps pivot. That's what the market's thinking about. But let's get into that for a little bit. So the headline CPI came out year-over-year basis, 5%. 3-month change is in the 3-handle area, down dramatically from where it was at its peak for sure. But beneath the surface, median CPI suggests that inflation remains persistent. Here, year-over-year inflation 7%, 2 percentage points higher than what we're seeing at the headline, higher than what we're seeing even in the core, which takes out food and energy prices. Even on a 3-month basis, it's still above 5% in median CPI is. So why do we look at median CPI rather than the headline data? Well, first of all, headline data is noisy. Look at how it moves all over the place. Median CPI tends to trend. Those trends tend to persist. The Fed is focused on a persistent improvement in the inflation environment. Yes, we've gotten some headline improvement, not enough beneath the surface, I think, to really give the Fed a lot of confidence that their inflation fight is done. Enough to pause, perhaps, but to say, okay, we're done. We don't need to do anything else. I think it's premature to kind of take that stance. But that's not the stance that the market is taking. The market's saying, yeah, the Fed, you reached your target. You got to where you said you were going to be last week by getting to 5%. The market though now thinks over the second half of this year, not just pause, not just 1 or 2 rate cuts. Right now, 3 rate cuts are priced into futures by the end of this year. And the bias is towards a 4th rate cut. The Fed on the other side saying, yeah, we reached our target. Let's reassess. Let's see if we need to do any more rate hikes or if we can indeed pause. And remember, going into this last meeting, the bias from the Fed was actually towards more rate hikes over the course of the second half of this year. Yeah, the median dot on the dot plot, that's at 5%. But there's plenty of dots above that, so to speak. And so when the Fed meets in June, not only do we get a rate decision, we'll also get an updated summary of economic projections, including in that updated dot plot and expectations for where the Fed sees the market finishing this year. And you look at probability weighted average Fed. You add up all the dots, 5.15% year-end Fed funds rate target. The market right now below 4.25. So almost 100 basis points difference between where the Fed sees rates being at the end of this year and where the market sees them being at the end of this year. And we're moving towards mid-year. So there has to be some reconciliation here between what the market's pricing in and what the Fed is talking about. The other side of the inflation data, not just whether the Fed can pause or pivot, is what's happening in terms of the real economy. And here we're looking at real weekly earnings. So this combines the employment data that we got on Friday, plus this week's inflation data, and we have this statistic, this average real weekly earnings, that I think tells a good story about what's happening in the economy. It's not good in terms of a healthy story, but I think it's an honest story about what's happening. So the headlines after the payroll data was more jobs, higher wages. What got lost in the mix was fewer, a shortened work week, which meant that the aggregate hours worked actually declined last month, and that the average weekly earnings we're growing less than average hourly earnings. So average hourly earnings overstated kind of the wage improvement that workers were getting. And that's what we're seeing here when we look at it on a real basis and on a weekly basis. So weekly earnings, not hourly earnings, real, not nominal. We can see that, the average paycheck, the purchasing power of the average paycheck, no different now than it was pre-COVID. And yes, it's less negative on a year-over-year basis than it was, over the last part of last year and early part of this year. It's still negative. The purchasing power of worker paychecks is still contracting. And so, yes, there's all this talk about resiliency in the economy. Beneath the surface, there's less flexibility, less improvement, less strength than the headlines suggest there are. I don't know that prompts the Fed to take action and start to ease rates. I doubt that it does, but I think it speaks to what's actually happening in the economy right now. And so just at, more broadly from a labor perspective, I mentioned average weekly hours contracting. That's part of the leading economic index. Another thing that's part of that, jobless claims. Jobless claims today shot up to their highest level since 2021. So at the edge, we're seeing some deterioration in labor market conditions, even as some of the headlines, even as some of the lagging data suggests things are still relatively okay. There's some chinks in that armor now. The good news is that as we went into earnings season, it looks like analysts, sell-side analysts that project earnings estimates actually got too bearish. And so now coming out of earnings season, we're actually seeing earnings revisions start to trend higher. Earning analysts are having to take those estimates higher. In fact, we're seeing the highest level of this earnings revision trend in almost a year now for the S&P 1500. So that is supportive of what we're seeing in terms of the indexes as analysts have to revise expectations higher, as they have to chase higher. That's typically a tailwind for equities, and much better than what was happening over the course of last year, which is earnings estimates were being brought down repeatedly. That weighs on stock prices. Remember, it's not a question of whether earnings are good or bad. It's a question of whether they're better or worse. And if the earnings revision trend is turning higher, it means that earnings and expectations for earnings were too negative, and it looks like they're going to be better than had previously been expected. We'll see if this holds up as we go into the summer, but it's heading in a good direction right now. Another look at sentiment is weekly surveys. AAI data out today continues to show more bears than bulls. One longest stretches in history, it's like 98% of the time over the past year, we've had more bears than bulls. Never seen something like that before. Here we're looking at the Investors Intelligence data. They also have a bull-bear spread. Over the past few weeks, that's leaked lower. Now it's still above this threshold that we have on the chart here, around 18%, coincides with last August's high. But as we leak lower, as we see a lack of sponsorship and engagement on the part of investors with any degree of index level strength that we're seeing, it is a reminder that one of the headwinds for sustainable strength emerging this year, and since if it was a bear market low, since that bear market low, one of the headwinds is a lack of optimism, the lack of embrace of equities. And at the end of the day, it takes bulls to have a bull market. You can have too many of them. That's when bull markets tend to end. But if you're going to have sustained strength, investors need to step in, have to embrace equities. All of the net gains since 2015 have come when the II bull bear spread has been above 18%. It's still there, but it's leaking lower. Watch this going forward, and the bull market thesis could really use more optimism emerging from a sentiment perspective at this point. From a long-term perspective, this has been a bit of a unique cycle. Well, not unique from a long-term perspective, but from a recent perspective, as you know, that's how long it's been since we've had a new high for the S&P 500. 339 days since we saw those peaks in early January of 2022. That's not just long relative to, kind of the recent history, longest since the financial crisis, and ended, and then we made new highs in the wake of that. But you go back to 1950, it's the 10th longest stretch that we've had in the history of the data. So it's a different environment than we have had in recent years, where, you had some drawdowns, but they were quickly recouped, and the march to new highs was resumed. This is looking more and more like these secular periods, 2000 to kind of 2012, late 60s to early 80s, where we went through these extended periods of sideways action in the market, these secular bear markets for U.S. stocks, these long, choppy, sideways environments that wear investors out, that test their patience, that lead to some bad decision making along the way. This is starting to look more and more like that. 339 days, we could go to the end of this year without making a new high, and we would still only climb into the number 6 spot. So we would eclipse, we'd be around 500 days at that point. So get rid of this one from the late 80s and the early 80s. And then he's in the late 60s or early 60s. We'll see if we get there. But if you feel like you've been missing out on the new highs, it has been a while based on recent history. Historically, we're not at extremes just yet. From an index level perspective, one of the challenges for getting to new highs is the lack of new highs beneath the surface. Here, we shared this earlier this week. Red line is the percentage of NYSE plus NASDAQ stocks making new 52-week lows. Green line is a percentage making new 52-week highs. This is both cumulative over the trailing 2 weeks. So it's not just the number of new highs and number of new lows, on a 10-day basis, but it's the number of unique stocks making new highs and new lows. 20% of the NYSE plus NASDAQ have made new lows over the past 2 weeks, which is interesting because on no individual day did even 10% of stocks make new lows. So it's not the same list over and over again. It's actually, 1/5 of this universe making new lows. And over time, the generals can do what they want. The mega cap stocks can try to power the indexes higher. But over time, if the army is not taking the field, or in this case, if the army is in retreat, it's hard for the indexes to sustain strength. And so where does that leave us? It leaves us range bound, which we've been in for a while, but with the breadth bias lower. So I still think those last summer lows on the S&P 500, 3,700 to 4,300, those are super important to pay attention to. Probably a lot of noise, with any movement within that's probably a lot of noise. Drew line here at 41.75. We're bumping up against that again. We were there earlier this year, touched it a couple times last year. Looks like it's kind of important. What's interesting now is that it's coming with more new lows than new highs. When we saw it earlier this year, we actually had more new highs than new lows. That was that breadth improvement that we saw earlier this year, actually an encouraging sign. Unfortunately, it faded and has not been replaced. And so if we couldn't do it, if we couldn't get through above 41.75 earlier this year, when we had more new highs and new lows beneath the surface, it makes me really question whether or not we can now, when in the US we see more new lows and new highs. And as we've talked about from a portfolio applications perspective, while this is a challenging environment in the US, when we start to look overseas, we start to see a much better picture emerge. Long-term trends overseas are all turning higher. The US is the only market in our 7-region framework that is not in an uptrend. Mexico, neighbor to the south, just hit all-time highs earlier this week. And so if we're stuck in this framework where we have to look for U.S. equities to lead and look to U.S. equities for exposure, we're missing the opportunity. We're being captured by a recency bias and a home country bias. And breaking out of that, I think, is going to lead to better opportunities as we go forward. That's the Market Insights update for this week. I'm glad you tuned in. Like I said, it's springtime here in Milwaukee, so I'm going to wrap up my work. I'm going to get outside to see what needs to be planted, what needs to be watered, what's grown since I last checked this morning. Glad you tuned in. Do these every week. Hopefully next week you'll tune in again, and we'll talk about what's happening in the market, what we need to pay attention to, what we can safely ignore, what the noise we can tune out. So thanks again for listening. I'll talk to you again next week, everybody.